Welcome to the tutorial on management accounting. Today the chapter is life cycle costing. Life cycle costing is the accumulation of cost over a product's entire life. In life cycle costing, we calculate all the cost of a product's entire life. That means in a product life cycle costing, we consider all the costs that will be incurred from design to abandonment. That means we start our designing process from research and development, R&D, and the last stage of the product life cycle is abandonment, disposal of the product from the market. After determining all the cost from the product's entire life, we compare the cost with the entire revenues that can be generated from selling this product at different target prices throughout the product's life. And this life cycle costing can be calculated for a product, for a service, for a customer, for a project over its entire life cycle, with the aim of maximizing the return over the total life while minimizing cost. That means the purpose of life cycle costing is to maximize the return by minimizing the cost. And in the first stage, we calculate all the cost of the product's entire life. Then we compare the cost with the entire revenues which can be generated from the selling of the product. But traditionally, we calculate the cost and revenues for a product or service on a financial year basis, for a particular period. But in life cycle costing, we calculate or we accumulate all the cost over a product's entire life. For your clear understanding, we can see the difference between the traditional cost accumulation and life cycle costing. We can see traditional cost accumulation systems are based on the financial accounting year. Traditionally, we accumulate the cost of a product for a particular period. It may be 1 year, 12 months period. But in life cycle costing, we accumulate cost over a product's entire life. In traditional cost accumulation, we do not accumulate cost over a product's entire life cycle and do not therefore assess a product's profitability over its entire life. In traditional cost accumulation, we cannot determine the profitability of a product for the entire life of the product. That means in traditional cost accumulation, we determine the profitability for a particular period. It may be 1 year, 12 months. But in life cycle costing, we determine the total expected profitability of a product over its entire life. That means in life cycle costing, we track and accumulate actual cost and revenues attributable to each product over the entire product life cycle. That means we consider the total profitability of the product for the entire life. Why should we calculate life cycle cost? After accumulating all the cost of that product for the entire life cycle, we compare that cost with the entire revenue that can be generated from that products for the entire life cycle. By comparing, if we can see that the generated revenue is lower than the cost, then we need to do cost reduction. And for that cost reduction, we need to improve our production process so that we can reduce our product cost. That is the reason for which we calculate life cycle cost. We calculate all the cost, then we calculate all the estimated revenues, and after comparing with the cost and revenues, if we can see that the cost is higher than the estimated revenue, then we should reduce the cost. And for reducing the cost, we need to improve our production process. But if we are not able to reduce the cost, in that case, we should not design the product, or we should not go for producing the product. What are the advantages of life cycle costing? By using the life cycle costing, we can assess the profitability of the product over the full life cycle. Then we can decide whether we should develop the product or whether we should abandon the production process. Through this life cycle costing, we can estimate sales volume and prices. The life cycle concept results in earlier actions to generate more revenue or to lower cost. If we can accumulate all the cost, then if we can compare the cost with the revenue, in that case, we can take actions to generate more revenue or to lower cost in the earlier stage of designing the product or service. Better decisions should follow from a more accurate and realistic assessment of revenues and cost, at least within a particular life cycle stage. Life cycle costing encourages long-term thinking and forward planning. What are the stages of product life cycle? We can see there are 5 stages in the product life cycle, and this is the curve which is indicating the profit, and this curve is indicating the sales revenue. And the stages are development stage. I mean, a company start to develop a product from the R&D department, I mean research and development. After that, it introduces the product. Then the product goes to the growth stage, and after that we can see the maturity stage, and the last stage is decline. At the stage of decline, company should withdraw the product from the market. I mean, in the decline stage, the product should be disposed from the market. Here we can see the characteristics of the product life cycle. In the development stage, we don't have any sale, but we have to spend lots of money for research and development. In the introduction stage, sales volume is low, but we have to spend high fixed cost for non-current assets and advertising. In the growth stage of the product life cycle, we observe rapid increase of sales. In case of cost, we can see there is an increase in variable cost, as well as there are some fixed cost increment for increased number of factories. And in the maturity stage of the product life cycle, the sales volume is stable and high sales volume. And in case of cost, we can see primarily there are variable cost. And in the decline stage, our sales volume fall because there is a falling demand. And in case of cost, we can see primarily variable cost, but the variable cost will decrease, and there are some fixed costs such as decommissioning cost. Elements of a product's cost over the life cycle. I mean, these are the costs which incur throughout the life cycle of a product. We can see research and development cost. Under this R&D cost, we have to spend design cost, cost of making a prototype, testing cost, production process, and equipment. I mean, we need to purchase the equipment for producing the product. Then we can see we need to purchase any technical data that is required for the production process. I mean, we may need to purchase the right from another organization to use the patent. The training cost include initial operator training and skills updating. Then production cost when the product is eventually launched in the market. After that, we need to spend distribution cost. It includes transportation and handling cost. After that, we can see marketing and advertising costs such as customer service, field maintenance, brand promotion, etc. Then we can see inventory cost. After producing the product, you may need to store the products in a warehouse. And at the last stage, we can see retirement and disposal cost. Whenever the product reach to the decline stage, you need to retire, to dispose the product from the market. So these are the cost. Cost start with the research and development cost, and it ends with the retirement and disposal cost. We have already learned that the main purpose of product life cycle is to maximize the return or revenue. And to maximize the return or revenue, we can adopt some ways. We can see we need to design cost out of products. We need to design and produce the product in a way so that we can reduce the cost. If the cost is higher than the revenue, then we should take steps so that we can reduce the cost. Or we can maximize the return by minimizing the time to launch the product in the market, as well as we can minimize the break-even time, and we can extend the length of the life cycle itself. If we want to maximize the return, we can extend the length of the product life cycle. So these are the ways by which we can maximize the return or maximize the revenue from a product by utilizing the techniques of product life cycle costing. For clear understanding, there is a illustration or a problem or a question from which we will calculate the cost per unit for a specific product throughout the whole life cycle. In this illustration, we can see Solaris. It's a company name, Solaris. This company specializes in the manufacture of solar panels. That means the product name is solar panels and the company name is Solaris. The company is planning to introduce a new slimline solar panel, especially designed for small houses. Development of the new panel is to begin shortly, and Solaris, the company, is in the process of determining the price of the panel. The company expects the new product to have the following cost. So these are the estimated cost for the product whole life cycle. We can see the cost start with the R&D, then marketing cost, then production cost, then customer service cost, ultimately disposal of special equipment. This is the withdrawal cost of the product from the market. And there are some other data. We can see units manufactured and sold. In the first year, they will be able to sell 2000 units. In the second year, 15,000 units. In the third year, 20,000 units. And in the fourth year, 5,000 units. So these are the data you can estimate by analyzing the market with the help of your employees. After estimating the possible sale in the years of the product life cycle, you need to estimate all the cost for producing the product, for designing the product, and for ultimately disposing the product from the market. We can see the R&D cost for first year is 1,900,000, and in year 2, 100,000. And marketing cost 100,000 in first year, 75,000 in second year, 50,000 in third year, 10,000 in fourth year. Production cost, but these production costs are showing the per unit cost. If we are interested to calculate the total cost, then we need to multiply this 500 with the units produced, 2000. That means if we want to calculate the total production cost, then we need to multiply this 500 with the units produced, 2000. Then we can see production cost for the second year. It is also showing the per unit cost, which is 450. and we need to multiply this 450 with the 15,000 units to get the total production cost in the second year. Then we can see production cost per unit in the third year is 400 and in the fourth year is 450. After that we can see customer service cost per unit. It is also showing the per unit cost. For calculating the total cost, we need to multiply this per unit cost with the units sold. Here customer service cost per unit is 50 and we need to multiply it with the 2000 units sold. In the second year the customer service cost per unit is 40 and in the third year same 40 and in the fourth year same 40. And at the last stage the disposal of special equipment for that product, this is the disposal cost 300,000. So these are the cost for the entire life cycle of the product. You need to estimate this cost by consulting with the related employees of the company, and you can estimate the units of sale by doing the market analysis. However, we can see marketing director believes that customer will be prepared to pay $500 for a solar panel. But the financial director believes this will not cover all the cost. If you consider all the cost, then this 500 is the selling price, but the cost will be higher. The per unit cost will be higher than the 500 cost. However, we need to do the calculation to get clear idea, and for doing the calculation we need to consider all the cost throughout the life cycle. That means our requirement is we need to calculate the cost per unit looking at the whole life cycle, and we need to suggest what should be the decision, whether we should produce the product for the available price, 500. So here we can see the solution. We need to calculate all the cost. We can see R&D cost. From the question we can see our R&D cost is 1,900,000 in the first year and 100,000 in the second year. We have shown it, and after adding we can see the total is 2 million. And our marketing cost 100,000 in the first year, 75,000 in the second year, 50,000 in the third year and 10,000 in the fourth year. After adding all the cost, we can see the total cost is 235,000. Then we can see production cost. These are the unit cost. We need to multiply this unit cost with the units produced. Here the units produced in the year 1 is 2,000, year 2 15,000, year 3 20,000 and year 4 5,000. If we multiply these units produced with the production cost per unit, we will get the total production cost for each year. Here we can see production cost for first year is 1 million, second year 6,750,000 and in the third year 8 million and in the fourth year 2,250,000. Total 18 million. After that we can see we need to calculate the customer service cost. Here this is the per unit cost, and we need to multiply this cost with the units sold, which is 2,000 here, 15,000 here, 20,000 here, 5,000. After multiplying this cost with the units sold, we will get the customer service cost. These are the costs. After multiplying and adding, the total is 1,700,000. And in the last stage our disposal cost is 300,000. Here the disposal cost 300,000. The total cost is 22,235,000. This is the total cost of the product for the whole life cycle. And from the question we can see our total production or total sale amount is, we need to add this 2,000, 15,000, 20,000 and 5,000. After adding these units, we can see that our total production units or total sale amount is 42,000 units. And to get the per unit cost for the product's whole life cycle, we need to divide this whole life cycle cost with the total production. Here total production is 42,000. So after dividing the whole life cycle cost for the product with the units produced or sold, we can get the cost per unit 529.40. From the question we have seen that The available sale price is 500, but our whole life cycle cost is 529. That means cost is higher than the available price. This product is not a profitable product. As a manager, we need to decide how can we minimize the cost or whether we should charge a higher price. But charging a higher price for a product is not possible because customer may not accept the higher price. In that case, the best option is to reduce the cost. For reducing the cost, we can apply various methods such as we can use different materials, we can use cheaper stuff, or we can acquire more efficient technology for the production. Whenever we can see that after doing the life cycle costing, if the cost is higher than the available sale price, then we need to charge a higher price or we need to reduce the cost. But charging a higher price will not be a good decision if the customer are not interested to purchase the product with a higher price. That's why our best option is to reduce the cost, and for reducing the cost we can apply these techniques. We can use different materials, or you can use cheaper stuff, or we can acquire a more efficient technology for the production. We calculate all the cost throughout the whole life cycle of a product or service. Then we compare the cost per unit with the sale price. After comparing, if we can see that our cost is lower, then we can go for producing the product. But if the cost is higher, then we need to decide whether we should produce the product or we should abandon the product. But if we consider that we need to produce the product, then we can charge a higher price, but it would not be a good decision for sometimes. That's why the best option is to reduce the cost. Thank you.